Hello, today we'll deal with part 4A, that is leasing and hire purchase. A lease represents a contractual arrangement whereby lessor grants the lessee the right to use assets in return for periodical lease rental payments. In simple terms, lease is a method of acquiring right to use an equipment or asset for a consideration. The consideration for the lease is called rent. Lessor, the owner of the equipment or asset, permitting the use of the same to the other party on payment of a periodical amount is called as a lessor. Next, lessee, the party who acquires the right to use equipment or asset on payment of periodical charges termed as rentals is called as the lessee. Now we will deal with the types in leasing transactions. Number 1. Financial lease. Financial lease, as it is clear from the name itself, provides full finance for the acquisition of asset to the lessee in return for rental charges paid throughout the economic life of the asset. Therefore, also known as full payout lease. In this type of lease, the lessor transfers substantially all the risk and reward related to the asset to the lessee and bears only financial risk and reward. The period of contract covers the entire economic life of the asset. Ownership is transferred to the lessee at the end of the economic life of the asset. Second, operating lease. Operating lease is a contract where lessor, the owner of the asset, grants the right to use the asset to the lessee for a particular period for which is shorter than the economic life of the asset, without any transfer of ownership rights, in return of regular payments for an agreed period of time. Next, leveraged lease. In this type of lease, there are three parties involved: lessee, lessor, and lender. The lender and the lessor join hands to accumulate funds to buy the assets to put it on lease. Equity is arranged by the lessor and debt is financed by the lender or financer. The lessee makes periodic payments to the lessor, who in turn makes payment to the lender. Next, sale and leaseback leasing. In this type of lease, the owner of an asset sells that asset to the lessor and then gets the asset back on lease from the lessor. The purpose of the leaseback is to free up the original owner's capital while allowing the owner to retain possession and use of the property. A sale and leaseback can be beneficial both to the buyer as well as to the seller. The seller gets a lump sum of cash quickly, which improves the liquidity. The lessor gets the benefit in terms of tax credit and a flow of regular income. Next, cross-border lease. It is also known as international lease. The lessee and the lessor are situated in two different countries. Example, a leasing company in USA makes available an aircraft on lease to an Indian aircraft company. There would be a cross-border lease. Direct lease. Direct lease is a financing arrangement by which the lessor buys the property and rents it directly to the lessee. In such cases, the owner of the property truly never intends to ever directly use it for its intended purpose. It is simply for investing and making future profits. Next, balloon lease. A lease which has no or zero residual value at the end of the lease period. In other words, lease agreement which has low lease rentals at the inception, high at the mid-years and low again at the end of the lease. Next, close and open-end lease. In close-ended lease, the assets get transferred to the lessor at the end of the lease contract period. Whereas in an open-end lease, the lessee has the option to purchase the asset. Next, upfront and back-end lease. In an upfront lease, higher lease rentals are charged in the initial years and lower rentals in later years of the contract. Whereas in the back-end lease rentals are less in the initial years and increase in the later years. Next, percentage lease. In percentage lease, the lessor needs to pay fixed lease rental plus some percentage of the previous year's gross revenue. Next, partial payout lease. When the lessee gains credit for the residual value of the leased item after the lease period is completed and the lessee pays the difference between the original price and the resale value plus interest charges. Next, turnover lease. A turnover lease is one where the rent payable by the tenant is either wholly or partly determined by the actual turnover achieved by the lessee. Turnover leases are more often used in relation to retail operations and almost exclusively used in factory outlet centers, airports, and railway stations. Next, dry lease. When the payment of insurance and maintenance cost is borne by lessee, lease agreement is termed as dry lease. Next, the last one, wet lease. A wet lease is a leasing agreement whereby the lessor provides an asset along with maintenance and insurance (ACMI) to lessee or other type of business acting as a broker of lessee, which pays by hours operated. Now we move on to the advantages and disadvantages of lease. Starting with the advantages. Number 1. 100% financing. The leasing company may finance 100% cost of the equipment without insisting for any initial disbursement by the lessee, whereas 100% finance is generally never allowed by the banks or financial institutions. Second, leasing arrange faster and cheaper credit. Banks, financial institutions may involve lengthy procedure, terms and conditions to the sanction loan. The process is time consuming. In contrast, leasing companies may arrange for immediate purchase of equipment on mutually agreeable terms. Next, increases borrowing capacity of the lessee. Use of lease financing does not create extra burden on firm in the form of loan or equity for purchase of asset. Lease obligations are not reported as a liability in the company's balance sheet. Thus, leasing helps the lessee to report a better debt-equity ratio. It also offers further borrowings in case the need arises. Fourth, protection against obsolescence. Lease arrangements help to protect the lease against the risk of obsolescence in respect of the assets, which becomes obsolete at a faster pace. In other words, the risk of the asset becoming obsolete due to technological advancements is borne by the lessor. Next, transfer of risk. By leasing, one transfers the uncertainties and risk of equipment ownership to the lessor, which allows one to concentrate on the productive part of the business. Next, overcoming financial crisis. By employing sale and leaseback arrangement, the lessee may overcome a financial crisis by immediately arranging cash resources for some emergency. It frees working capital for more productive use. Next, tax benefits. A lessee is able to enjoy the tax advantage on lease payments, as lease payments can be deducted as a business expense. In case of a non-tax paying lessee, the cost of financing an asset is much higher as compared to a tax paying lessee. Next, flexibility. Leasing arrangement may be tailored to the lessee's need more easily than ordinary finance. The rental schedule can be adjusted to accommodate genuine need and problems of the lessee. Next, high profitability. The business of leasing is highly profitable since the rate of return based on lease rental is much higher than the interest payable on financing the asset. Lessor gets rent by leasing an asset during the period of lease, which is then assured and regular income. Next, recovery of investment. In case of finance lease, the lessor can recover the total investment through lease rentals. Last, boon for small firms. Acquisition of assets through a leasing arrangement is particularly beneficial to small firms. Now we move on to the disadvantages. Number 1, no ownership. The main disadvantage of leasing is that the business will never own the asset. It remains the property of the leasing company during and after the lease. The only exception is in the case of financial lease. Second, consequence of default. If the lessee makes default in payment of lease rentals, the lessor can terminate the contract and take back the leased assets. In case of financial lease, the lessee needs to pay for damages and higher lease rentals in case of default. Next, unprofitable in case of inflation. Lessor gets fixed amount of lease rental every year and they cannot increase this even if the cost of the asset goes up. Fourth, greater chance of damage of asset. As ownership is not transferred, the lessee uses the asset carelessly and there is a great chance that asset cannot be usable after the expiry of primary period of lease. Fifth, compulsion. Finance lease is non-cancellable, and even if a company does not want to use the asset, lessee is required to pay the lease rentals. Under financial lease, the lessee will not be in a position to terminate the contract except by paying heavy penalties. Sixth, ownership. The lessee will not become the owner of the asset at the end of the lease agreement unless he decides to purchase it. Seventh, costly effect. Lease financing is costlier than any other source of financing because lessee has to pay lease rental as well as expenses incidental to the ownership of the asset. The interest cost of lease financing is generally higher than that of debt financing. 8. Understatement of assets. As lessee is not the owner of the asset, such an asset cannot be shown in the balance sheet, which leads to understatement of lessee's asset. Now we will deal with hire purchase. Two parties are involved, mainly in hire purchase agreement, are hire vendor and hirer. Hire vendor means the person who lends or delivers the possession of goods to the hirer under a hire purchase agreement. Hirer means the person who obtains possession of goods from an owner under a hire purchase agreement. Hire purchase is a method of selling goods. In a hire purchase transaction, the goods are let out on hire by a finance company, that is creditor, to the hire purchase customer, that is the hirer. The buyer is required to pay an agreed amount in periodical installments during the given period. The ownership of the property remains with the creditor and passes on to the hirer on the payment of the last installment. Next, we will discuss the characteristics of hire purchases. Number 1. Hire purchase price. Hire purchase price is paid in installments up to the agreed period of the agreement. Second, installment. Each installment is considered as a charge for hiring the asset. This means that if the hirer defaults on any payment, the seller has all the rights to take back the asset. Third, terms and conditions. All the required terms and conditions between both the parties are documented in a contract called hire purchase agreement. Fourth, mode of installment. The mode of installment may be annual, half-yearly, quarterly, monthly, etc., according to the terms of the agreement. Fifth, possession of asset. The possession of asset is transferred immediately to the hirer as soon as the agreement is signed. Sixth, option to purchase. If the hirer used the option to purchase, the assets are passed to him after the last installment is paid. Seventh, option to return. If the hirer does not want to own the asset, he can return the asset anytime and is not required to pay any installment after the return. 8th, claim. However, once the hirer returns the assets, he cannot claim back any payments already paid as they will be considered as hire charges for use of the assets till the date. 9th, not the owner till last payment. The hirer cannot pledge, sell or mortgage the asset as he is not the owner of the asset till the last payment is made. 10. Down payment. The hirer usually pays a certain amount as an initial deposit while signing agreement, known as down payment. Termination. Generally, hirer can terminate the hire purchase agreement any time before the ownership rights pass to him. Next, we move on to the advantages of hire purchase. Now, what is the advantage to the seller? Number 1. Higher sales. Hire purchase is one of the methods of selling goods. It helps to increase the sale of his goods. People with small income can buy expensive equipment, machines, cars, etc. They can make payment in easy installments. Second, ownership of the goods. Ownership of the goods passes to the hire purchaser only on payment of the last installment. Still, the ownership lies with the seller. Third, take possession. In case of any default by the buyer, the seller can take back the possession of the goods. Fourth, forfeiture of installment. In the event of the buyer's default, the seller can forfeit all the money paid by the buyer as rent for using the asset. Now, moving on to the advantage to the buyer. Number 1, facility of buying. People with small income or small or medium industries can buy expensive assets easily through hire purchase. The buyer can make payment in easy installments and hold an asset after payment of the last installment. Second, finance facility. For small medium industries, if they want to acquire any asset, there is no need to invest huge amount at a time. They can have finance facility through hire purchase scheme. Next, boon to small producers. Small scale units and farmers can buy machinery or equipment and pay installments out of earnings. Fourth, possession of goods. In this system, the buyer takes possession of the goods immediately. Hence, the buyer can start to use the goods before making full payment. Now we move on to the disadvantages of hire purchase. Number 1, risk of bad debts. When the buyer fails to pay installments, the seller may suffer loss. He may have to spend money and time to recover goods from the buyer. Second, large investments. The hire purchase seller has to invest considerable funds because payments are received from buyers over a long period of time. Third, higher prices. The buyer has to pay much higher prices than that payable on cash purchase. The seller adds a margin to cover interest and risk. And lastly, ownership. The ownership of the asset is transferred to the buyer only after the payment of all installments. Thank you.